Welcome to this explainer on stock delisting. We're breaking down criteria, consequences, and the wild OTC market.
So, what actually happens when a major public company gets kicked out of the Wall Street VIP club?
Simply put, delisting is when a security gets completely removed from the exchange where it actively trades.
Think of major exchanges like the NYSE or Nasdaq as super exclusive clubs with incredibly strict cover charges.
To stay in, you gotta maintain strict metrics, like a $1 minimum share price and 400 total shareholders.
Fall below those numbers, you'll get a scary non-compliance letter and a short grace period to fix it.
Fail to act? You get the boot for low prices, missing SEC filings, going bankrupt, or unpaid fees.
Once kicked out, you're tossed into the over-the-counter markets. Relaxed rules, sure, but way wider bid-ask spreads.
It's a massive blow, honestly. Many institutional investors are strictly banned from holding these unlisted OTC stocks.
All right, let's step right into the Hall of Shame. Why do these major companies actually get booted?
Take Luckin Coffee. They listed from Nasdaq in 2020 after completely fabricating a staggering $310 million in sales.
Boom! Their stock price absolutely plummeted from over $50 to under $2 as investors bolted.
Sometimes it's just pure financial struggle, like tailored brands dropping below $1 a share during the pandemic.
Or you get caught operating as a shell company with zero real operations, like NextImmune in 2024.
Surprisingly, delistings can even be geopolitical, dictated strictly by government executive orders, ignoring standard financial metrics entirely.
For example, in 2021, the NYSE neutrally delisted China Mobile following a U.S. executive order alleging military ties.
Now, if a delisting happens because of bankruptcy, a little letter Q gets slapped onto the ticker symbol.
But General Motors actually showed us the comeback trail, hitting Chapter 11 bankruptcy before successfully relisting in 2010.
Beware though, if a bankrupt company hits liquidation, common shareholders can literally lose absolutely everything they invested.
To bounce back to the big leagues, companies must survive some seriously rigorous financial and reporting steps. It's also worth noting some companies just leave voluntarily to go private, like X Corp, formerly Twitter.
Going private totally frees management to focus on long-term growth, ditching that stressful short-term quarterly earnings pressure. Ultimately, a forced delisting usually means a sudden drop in value and severely decreased liquidity for retail investors.
So, I'll leave you with this. Are the potential rewards of unregulated OTC stocks actually worth the risk?